This is Chapter 2, Reviewing Financial Statements. So after finishing this chapter, we should be able to describe the major financial statements and analyze the information provided in those financial statements. Based on the information provided in the financial statement, we try to understand the concept of free cash flow and calculate a company's free cash flow. We also need to understand that when we examine a company's financial statement, we need to take cautions. So we are going to review 4 basic types of financial statements, including the balance sheet, income statement, statement of cash flows, and the statement of the retained earnings. From the accounting classes that you have taken, such as the financial accounting and managerial accounting, you understand that financial statement is an accounting-based picture of a company's financial position. So while the accountants prepare the financial statements to capture the company's financial performance in the past, as the finance professionals use these financial statements to try to draw some picture, some future inference about the company's financial performance and health. Now, before we get into all those statements, I want to make a statement that this lecture is a review of the financial statement, not really an introduction about how to construct this financial statement, because my understanding is that you have learned those from your financial accounting classes. So we focus more on understanding the basic structure of these financial statements and try to understand and interpret the information from these statements. We'll start with the balance sheet. The balance sheet reports a company's asset, liabilities, and equity at a point of time based on the principle that assets equals to liabilities plus equities. So on the left side, we have the asset of the company, and as we will explain later, these assets are ranked in order of liquidity. On the right-hand side here of this balance sheet, you see the liability and equity. So this is table 2.1 from your textbook, which is a sample balance sheet for a company called DPH Tree Farm Inc. And we have its balance sheet as of the end of 2018 and 2017. On the asset side, as you see, we have current asset and fixed assets. Current assets are usually assets that can be converted into cash within a year, and they usually include cash, marketable securities, accounts receivable, and inventory. Fixed assets usually have life longer than, or say more than a year, and they usually include physical assets, including the plant, property, and equipment, which is also called the PPEs. And we also have the intangible and long-term assets such as patents and trademarks. On the liability side, liabilities are loaned to the company. That would include current liabilities and long-term debt. Current liabilities are obligation due within a year, which means the company is supposed to pay off these liabilities within a year. These current liabilities include accrued wages and taxes, account payable, and note payable. Now, for the long-term debt, that usually include long-term loans and bonds, and their maturities are generally longer than 1 year. The accruals and the account payables are often considered operating or spontaneous current liabilities because they usually are accumulated automatically as a result of the company's day-to-day business, and they can also be tied to the change of sales. For example, with more sales revenue, there may be more account payable. But note payables usually are not considered as operating and spontaneous liabilities. Now, we want to differentiate the operating versus non-operating current liabilities, and that's useful later when we talk about the concept of the free cash flows. Equity, we can think of the equity as the difference between the company's assets and total liabilities. So equity is at the right lower corner of the balance sheet. Within the equity, we have preferred stock and we have common stock, including common stock par value and paid-in capitals. We also have the retained earnings, which is part of the common equity. Retained earnings are the part of the earning or say net income generated by the company that are retained instead of being paid as dividends. We'll talk about the detail of the retained earnings in the statement of retained earnings. So once you understand the framework of the balance sheet, now we can take a look at a practice question, which is question number 2 from the end of chapter 2 in your textbook. So we have this company, and at the end of 2018, it has current asset of this much, and fixed asset, current liabilities, and long-term debt. So the question is, how much is this company's total equity? So if we are looking at the balance sheet, we are provided with information of the current assets and long-term assets, so we can calculate the total assets, which is supposed to equal total liability and equity. And then once we have the long-term debt, the missing part is the stockholder equity, and so we can solve for the equity. And that's what we have on the next slide. So when we put all these general accounts on the balance sheet, we have the current asset, fixed asset total will be about $986,000, which is supposed to be the total of liability plus equity. So now the stockholder equity part should be the difference between the total assets and all the liabilities, including the current liabilities and long-term debt. So the result is $254,900. That's the amount of stockholder equity when you solve for the missing part of this balance sheet. In the next few slides, we're going to discuss the interpretation of balance sheet information from the following perspectives. We'll look at different depreciation method, or say the impact of different depreciation method on the balance sheet. We will discuss the concept and calculation of the net working capital. And then we'll take a look at the company's liquidity position. And we'll look at a company's method of financing, whether it's debt financing or equity financing. And we'll also take a look at the difference between a company's book value and market value. So now let's start with the depreciation method. Recall from your accounting classes that managers can choose different accounting methods to record depreciation against the fixed assets. So generally, for financial reporting purpose, companies often use straight line depreciation. But for tax purposes, companies often use accelerated depreciation method. So you understand in the first couple of years, when depreciating a fixed assets, accelerated depreciation would give you higher amount of depreciation expense than under the straight line depreciation. So when that happens, with higher depreciation expense, we'll end up with lower taxable income. And lower taxable income means lower tax to be paid in those early years. So the idea is when you use different depreciation method, you can end up with different depreciation expense amount, and that would affect the numbers, also the results in your balance sheet and also in your income statement. Now let's look at the so-called net working capital. Generally, working capital means current assets. So when we look at the net working capital, that is current assets minus the current liabilities. So that is actually to compare the amount of current liabilities that a company has with the amount of current asset that it had. And you understand that we want to have more current asset to cover over current liabilities so that we can have cash to pay the bills. So that would need a positive net working capital. So a positive net working capital usually can be a good sign of companies' so-called working capital management, meaning that company can have or say come up with enough cash to cover its current liabilities. Next issue is about liquidity. We all understand that liquidity means the ability for a company to convert its assets, usually the current asset, into cash at a fair market value. And current assets are, of course, considered as most liquid, or say more liquid than the long-term fixed assets. And among the current assets, we have cash, marketable securities. They are usually more liquidable than the accounts receivable, and accounts receivable is more liquidable than inventories. And so inventory is considered as the least liquidable current assets. And also current assets are more liquid than the fixed assets. When we say liquidity is a double-edged sword, that means we want the company to have decent level of liquidity, because with more liquidity, companies can pay for their obligations more easily. They have enough cash, right, to cover their bills. So that makes the business less risky. However, if the company has too much liquid assets, those liquid assets actually offers, or say, can generate very low return. Cash itself generates zero return. It is actually the illiquid, usually the fixed or long-term asset, that can be used to generate revenue and profit for the company. So we are looking at a trade-off between liquidable assets that are less risky but low return versus the illiquid asset that can generate return but has low liquidity, or say maybe a little bit higher risk. We'll talk a little bit more about liquidity in the next chapter when we study the liquidity ratios. At this point, you just need to understand that very low liquidity can be risky, but too much liquidity may not be a good thing for the company either. Next thing we look at is the company's financing method. So company either finance itself by debt, or say borrowing money, or equity, or say raising equity. In finance, we have a term called leverage. So financial leverage simply refers to a company's use of debts, or say how much money it has borrowed. Debt holders, they have fixed claim on a company's cash flow. So if the company borrows money, they are supposed to pay back the debt, interest plus principal. And how much they're supposed to pay back, that are based on the contract of the debt. So debt holders pretty much know how much they are getting back from the company. Shareholders, on the other hand, they have claims on the remaining cash flow, meaning the cash flow left by the company after they paid the debt holders. So how much can be left, that is unknown. Leverage can magnify gains and losses for the stockholders. If a company does very well, financial leverage actually can increase the reward for shareholders. That's because the profit that are needed to pay to the debt holders, that's set and fixed. Once that fixed amount is paid, the leftovers may or can be plenty that all go to the shareholders. But on the other hand, if the company is not doing very well, financial leverage actually increases the risk. So the leverage can create the potential for the company to experience financial distress and even bankruptcy, because the company legally have to pay back the interest plus principal to the debt holders. And if they fail to do that, debt holders have the legal right to pursue the payments and eventually drive the company to declare bankruptcy. Later in this chapter, when we review the income statement, we'll use the income statement to explain this notion that financial leverage can enhance the returns for investors. The last idea we'll discuss from the balance sheet is this difference between a company's book value and its market value. According to the current accounting principle, we have to record the numbers on the balance sheet based on the purchase or historical prices, and these values are called the book value. But this value can be very different from the asset's market value. The market value is based on the market price of the assets, such as the company's stocks. So, depending on how much the stock can be sold in today's market, we can see the market value. So we can look at Apple as an example. If we look at Apple's 2018 balance sheets, we can find that Apple's total common equity at the end of 2018, that is a book value, that is about $3.55 billion, which is a lot of money. However, if we look at the market value, we look at how much Apple stocks as a whole can be traded in the stock market. The total market value based on Apple's stock price and the number of stocks outstanding at that same time, that was around $741 billion. And that is significantly higher than the $3.55 billion. You see the difference between the book value and the market value for the same company at the same time can be huge.